Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals, in our 26th year in business. It's Thursday morning, October 1st, 2015, and the title of this week's audio blog is Predictions. Now, following the worst quarter for stocks, commodities, and essentially all asset classes favored by the powers that be, the dreaded fourth quarter has finally arrived. It's October 1st, and everyone knows October is the most dreaded month for the stock market, given what happened in 1929, 1987, and 2008. Of course, economic Mother Nature could give a darn what month it is, which is why there are no guarantees as to what October will bring. Just as there were no guarantees that the world would be able to enjoy its typical August vacation, as lo and behold, said powers that be's ironclad grip on financial markets slipped badly last month, and heck, Miles Franklin had its strongest month of business in more than 2 years, which I might add continued throughout September as savers and investors alike flocked to the time immemorial safety of physical gold and silver. Irrespective of the calendar, the world appears to be at a major inflection point, as not only is hope of an economic rebound dissipating, but the long-held faith that politicians, central bankers, and corporate titans can save us with deft policy changes is on the cusp of death as well. In fact, my sense is that a worldwide revolution against the people and policies that have sentenced the 99% and their kin to debt serfdom is underway, rapidly strengthening with each passing day. Some aspects of said revolution will be strategic and most peaceful, in my view. However, history tells us that dramatic economic changes, particularly for the worse, are accompanied by draconian government response, social backlash, and geopolitical tensions, followed by, in nearly all cases, war, both civil and international. Regarding the former, last week's Catalonian parliamentary elections, in which secessionists garnered a clear majority, and the prior week's Greek elections, in which anti-austerity parties won and neo-Nazis placed a strong third, are but two examples of the revenge of the people trend I forecast a year ago. And ominously, I don't expect to reverse anytime soon, perhaps not for generations to come. And of course, when such a dramatic zeitgeist change occurs amidst an environment of historically weak economic activity, unprecedented parabolically rising debt levels, unconscionably repressed interest rates, and historic financial asset bubbles, the prognosis for paper assets couldn't be bleaker. Whilst conversely, the prognosis for items of real value, like gold and silver, particularly as 15 years of price suppression have reduced saleable inventories to record low levels and undoubtedly caused production to peak, couldn't be stronger. Along those lines, the chatter I have witnessed in precious metals land indicates a significant inflection point as well, amongst not only die-hard gold bugs like myself, but those that observe closely and often trade the paper PM investment market. Yesterday's article, Real Money versus Paper PM Investments, clearly struck a chord, and hopefully after all these years, the majority of precious metal aficionados will finally understand why we own physical gold and silver, and why mining stocks, ETFs, and closed-end funds are not only mere speculations, but terrible ones at that. For the title of today's audio blog, which I'll get to after first this discussion, and next comments about the wide world of horrible headlines that have literally filled 7 pages of notes since my last article 24 hours ago, the Miles Franklin blog has never, nor ever will, predicted what gold, silver, mining shares, or any other financial market would do over a short-term time frame. And heck, I didn't even do that during all my years of posting free missives on the GATA website, going all the way back to 2004. To that end, neither I personally or the firm Miles Franklin are financial advisors, with not even the aspiration of being thought of as such. To the contrary, we are simply in the business of buying, selling, and storing precious metals, which we have been doing for 26 years with not a single registered complaint. And as for the blog, its sole purpose is the education of those not versed in the myriad factors affecting precious metal supply and demand, to enable you, the readers, to do your own due diligence. As for mining shares, however, longtime readers know I was once their strongest advocate, having owned them in large quantities from the day I went all in the sector in May 2002 until the day I sold my last mining share in the summer of 2011. During that period, the last 4 years of which I actually worked in the mining industry as an investor relations officer and/or consultant to dozens of companies, I experienced more ugliness, heartache, and financial distress than most observe in a lifetime. Between unrelenting cartel naked shorting of gold, silver, and the mining shares themselves, the slow, water torture-like shutoff of mining capital, conniving bankers diluting mining carcasses with toxic convertible bonds and equity warrants, behind-the-scenes battles between mining executives and accountants regarding the valuation of so-called reserves and resources, the hideous, unfathomably low liquidity of all but the largest share issues, the dramatic underperformance of mining shares versus actual gold and silver in both good and bad markets, and oh yeah, the catastrophic escalation of mining costs of all types, whilst ore grades collapse, political and environmental risks explode, significant gold and silver discoveries became an oxymoron, and the desperately needed human capital necessary to promulgate the world's most difficult industry disappeared, it became crystal clear to me that the odds of making extraordinary gains in paper PM investments could not be worse. And that, I might add, is what I'm talking about from between 2006 and 2011, which pales in comparison to the acceleration of all these trends in the subsequent 4 years. Moreover, unlike the heyday of mining share investment, in 2000 when the Huey bottomed to 2007 when the TSX Venture peaked, mining shares are no longer perceived by the market and particularly astute observers as having open-ended upside. The reason being that the major reason for owning them back then, a peaking US dollar index, has been dramatically usurped by the risk of a global economic collapse and worldwide hyperinflationary monetary event, after which gold and silver would likely be considered national security assets, which would likely result in catastrophic losses for nearly all paper PM investments. In other words, when the cartel is inevitably defeated, be it this year, next year, or thereafter, governments will undoubtedly seek to seize control of as much gold and silver as they can. Yes, a worst-case scenario could unfold in which the average person cannot safely and or profitably own precious metals. And if it does, it likely will be the least of your worries after safety, survival, and nutrition. But more likely, the world will see governments commandeer the means of production, i.e. gold and silver miners, windfall tax whatever still remains in public hands, and destroy the ability of miners to actually grow. Which, by the way, is the inevitable result of all government attempts to manage industry, otherwise known as communism. And under any of those situations, the gains one can make in mining shares, ETFs, closed-end funds, futures, and options are limited at best and negative at worst. Meanwhile, those holding the actual metal, with nearly none of the aforementioned risks, will have a better-than-fighting chance to benefit greatly, whilst the new 99% suffers immeasurably. And as for those saying, you're going to be wrong, the mining shares will surge, 1, I never said they wouldn't or couldn't rise, and 2, for those that have listened to my warnings, the sleep of the just you have enjoyed these 4 long years is my greatest reward. And by the way, for those getting excited about the so-called undervaluation of mining shares, which in most cases is fallaciously attributed to the fact that they have simply underperformed the metals for so long, keep in mind that the third quarter just ended, with gold and silver prices at multi-year lows, mining company balance sheets in their worst shape in 15 years, and the prospect of company-crippling write-offs hanging over the entire sector. To that end, one of my top predictions of 2015 was paralysis of the mining sector, which thus far has, as exemplified by Barrick's mad but ultimately too little too late dash to shed assets, has certainly been the case. That said, you ain't seen nothing yet, as my guess is said accountants will force many miners to start taking catastrophic write-offs. And if not, assuming the cartel is not defeated in the next 3 months, they will be required to do so at year-end, causing a wave of industry consolidation, capital and labor reductions, and in many cases bankruptcy that may well rival the shale oil industry. In other words, time is not on the side of miners, nor is finance, financial markets in general, or a cartel that can manufacture unlimited amounts of naked shortable shares. Conversely, these very factors have yielded record high demand for said metal, record low inventories, and perhaps the worst production outlook in not just decades, but centuries. Again, I am not predicting anything about short-term gold, silver, or mining share prices, but simply stating facts regarding their respective risk-reward profiles. Regarding said predictions, there is certainly one area I have no problem opining about, i.e., the direction global economic activity is going, and the ultimate endgame for the world's massive, unprecedented debts and collapsing, intrinsically worthless currencies. To that end, said 7 pages of notes, again from the last 24 hours alone, says it all, starting with Japan's miserable retail sales and industrial production numbers, which pushed third quarter GDP expectations into negative territory, prompting expectations of an expansion of Abenomics as early as the Bank of Japan's October 30th meeting. Next, a negative CPI reading in Europe, prompting not Wall Street, but Standard & Poor's to actually predict the ECB's cancerous 1.1 trillion euro QE program will be expanded to a whopping 2.4 trillion and extended by as much as 2 years. Gee, I wonder how much of that additional 1.3 trillion euros will be needed to fund the gaping financial deficit Spain will face when Catalonia leaves, taking 19% of Spanish GDP and 25% of its tax revenues with it. And how much of those printed out of thin air euros will be required to monetize the 600 billion or so of defaulted Greek debt that is sure to hit sovereign balance sheets like a ton of bricks during that time. Not to mention those of Portugal, Italy, and countless other nations from the first, second, and third worlds. Frankly, the horrible headlines are so broad and deep, you could say they have become the equivalent of the 1927 Yankees as far as the murderer's row of ominous, deleterious foreboding. In emerging markets, a term I can't help mocking, given it is a blatant propagandist way of trying to deflect the world's troubles on so-called lesser nations, when clearly greater nations have equally catastrophic issues, currencies are collapsing at an unprecedented rate, with good reason. Care of decades of Western, Federal Reserve-led interest rate suppression, dozens of nations with little financial wherewithal have been saddled with trillions of untenable debt. And frighteningly, the vast majority of these nations' only businesses are commodities production, a business which may be dead for a generation, and tourism, which will correlate perfectly with the collapsing global economy. This is why serial defaults, or as the Shemitah prophecy predicts, debt jubilees, are as imminent as they are inevitable. Puerto Rico, a quasi-U.S. protectorate that ultimately U.S. taxpayers will be on the hook for, was the first on this side of the Atlantic and Greece on the other. And within the next 12 months, you can bet your bottom dollar, euro, or yen that countless others will follow, having decidedly lost the final currency war, as ironically their currencies implode into oblivion. Heck, this morning alone, IMF President Christine Lagarde again pleaded for the Fed to not fuel this raging fire with the financial hydrogen bomb a credit tightening of any kind would act as, going so far as warning of a, quote, emerging market mass default. Don't worry, Christine, they won't raise rates in October or December or at any time prior to hyperinflationary fears forcing their hand. That said, the Fed's financial hydrogen bombs have already been detonated, which is why the entire world, as we speak, is on the verge of all-out economic and monetary collapse. Again, the currencies we're talking about are used not by millions, but billions of global denizens. From 200 million people in Brazil to 175 million in Nigeria, 75 million in Turkey, and oh yeah, 1.3 billion in India. Let alone when the upcoming cataclysmic financial big bang to end all big bangs, i.e. not a 5% token devaluation, but the massive 20% plus devaluation that's inevitable of the Chinese yuan, is enacted. This morning's record low Chinese service and manufacturing PMIs, both well below 50, indicate this inevitability is becoming more imminent each day. And trust me, care of the aforementioned final currency war, the Bank of Japan, ECB, and all central banks are aware, with their fingers on their own hyperinflationary buttons, just itching to press them. Of course, when Janet Yellen finally gives up the ghost of pretending the U.S. is recovering and presses her own massive red button, all the other buttons will become immaterial. As at that point, which if the PPT, Fed, Exchange Stabilization Fund, and or Gold Cartel lose control of their unprecedented market manipulations, may well occur by year-end. The endgame of global currency collapse will have then commenced. And when it does, you can bet today's modest silver shortages will be far closer to the acute conditions of 2008 for both monetary metals. And this at a time of record high demand, record low inventories, and a record low production outlook. As for the United States of fraudulent economic recovery, here's the economic data alone from the last 24 hours. For those still fearing a Fed rate hike, LOL, in October, let alone in December, when they would never act to jeopardize a potential Santa Claus rally and thus the bonuses of the Wall Street firms that own it. First, yesterday's hideous, recessionary August Chicago PMI number of 48.7 versus 54.4 in July and expectations of 53.6. Throw in the massive, again, unexpected build of API oil inventories, the 7% plunge in weekly mortgage and refinance applications, the Milwaukee PMI survey printing its lowest level since April 2009, and the Evercore ISI's trucking survey plunging from 65.4 a year ago to 51.0 in July, and it was a banner day for ugly economic data. As for today, it started with another unexpected explosion of September's Challenger job cut report, up 43% from August and putting 2015 in line to be the worst year for job layoffs since, drumroll please, 2009. Next up, the September PMI manufacturing index replicated August's two-year low of 53, as well as the two-year low in the all-important employment category. Sprinkle on some higher-than-expected jobless claims and the hideous, barely expansionary, and of course, unexpected 50.2 reading of the ISM manufacturing survey, and it was a clean sweep for those following the course of economic reality. In fact, comically so, the only number in the past 2 days that beat expectations is the hopelessly propagandized, completely dissociated from reality, and often recalculated downwards ADP employment report, which, in its everlasting goal of matching the BLS's own fudged NFP numbers, came in at the firm round number of exactly plus 200,000. No matter that the ADP report has a history of being revised downward, just as the BLS was last month when it revised its job creation estimate for the 12 months ending March 2015 by a whopping 208,000 jobs. It has had essentially no correlation with the BLS NFP report anyway, and oh yeah, for the first time since 2009, ADP reports that not a single manufacturing job in 2015 has been added. But don't worry, plenty of part-time, minimum wage paying waiters and bartenders have joined the working ranks, as well as an equally strong cater of phantom birth-death model jobs. In fact, if the historic correlation between the aforementioned ISM and PMI survey employment components and the ADP and NFP reports were to hold, as it decidedly should, tomorrow's September NFP report would be negative. But don't worry, the Wall Street consensus of LOL 203,000 won't be allowed to stray too far, even if the accompanying multi-year low in the so-called unemployment rate occurs amidst a new 4-decade low in labor participation and real wages. By the way, the last time net manufacturing growth turned negative, in mid-2006, it stayed that way for the next 4 years. And regarding those minimum wage jobs, how ironic that on the day sandwiched between the ADP's purported 200,000 service job gain and tomorrow's NFP expectation of 203,000, the nation's largest minimum wage employer, Walmart, announced hundreds of layoffs, not in the stores themselves, but in its high-paying home office. As for the markets, which I put in quotes because the word market is an insult to the intelligence of actual market observers, the efforts to window dress the end of the fourth quarter yesterday and the beginning of the first quarter today are two for the books. But forgetting yesterday's insane textbook manipulation of the Dow Jones propaganda average and paper gold and silver, the real story was the comical attempt to revive copper, or as I deem it in today's collapsing global economy, Dr. Death, in a blatant obvious attempt to save the monstrous Lehman Brothers of commodities, Glencore, and its evil but not publicly traded twin brother, Trafigura. Yes, out of the blue, with not a shred of positive economic data anywhere, and no other commodity market materially moving, we're to believe copper suddenly was worth 5% more than it in the morning. Yeah, and I have a bridge in Brooklyn to sell you. Meanwhile, the other market, Glencore and likely Trafigura, desperately need to hold up to prevent instant insolvency, i.e. zinc, barely budge higher. And this morning, copper, along with stocks, has turned already back down, just like the dead cat bounce orchestrated by the PPT's simultaneous attempt to turn Glencore's stock higher. And here we are this morning, with stocks again turning sharply lower, the benchmark 10-year Treasury yield, and symbol of the Fed's future intentions, finally about to breach the key round number of 2.0 to the downside, in anticipation of NERP and or QE4, and commodities of all types resuming their own inexorable plunge toward their inevitable breaching of last month's 40-year low. Throw in the National Bank of Greece's stock at a new all-time low of 46 cents per share, and all points are covered in the bearish Hurricane Joaquin-like storm that the fourth quarter likely has in store. As for precious metals, they continue to hold their ground against the most violent paper raids in memory, whilst inventories continue to decline, such as COMEX registered silver's new multi-year low yesterday. Heck, now that the Chinese have decided to tell the world they are acquiring gold, some very interesting data is emerging, such as, for instance, the completely unmentioned fact that the PBOC just purported to add 2.6 billion of gold reserves in August alone, or 15 times the entire value of the purported COMEX registered gold inventory. Heck, as Jesse's American Cafe reports, the so-called Silk Road nations of China, India, Turkey, and Russia overtly purchased a whopping 559 tons of gold in August, compared to total global production of no more than 230 tons. Gee, I wonder where that gold came from and how much more is left. Which brings me to today's topic of the predictions so many make and why they serve little purpose other than to sell subscriptions, generate publicity, fearmonger, or churn investors. As noted above, the only predictions I and the Miles Franklin will proffer are the directions things are headed, as well as the inevitabilities today's trends have created. Sure, my urgency may rise and fall with market movements and news flow, particularly when, like today, I sense imminent metal shortages. But generally speaking, I simply seek to inform you of the state of the global economy and financial markets and let you do the rest. That said, many in our field, and generally speaking the entire financial world, are constantly making near-term predictions. And as we speak, I cannot recall a period with so much fear and gloom and doom predicted. Yes, I agree completely that fundamentally speaking, the factors the Miles Franklin blog has warned of all along appear to be coming to a head at once, and this during the historically ominous October month. However, if they don't turn out to be true, at least during the dreaded fourth quarter, don't for a second take your eye off the ball, as in my mind the only way something terrible does not occur this quarter will be an utterly unparalleled combination of money printing, market manipulation, and propaganda. If you will, it's blow off top, which if not now, then shortly afterwards, will eventually do what all bubbles do, i.e. spectacularly collapse. And given that this bubble, whether speaking economically, financially, or of the power of governments, central banks, and ruthless corporate titans, is the largest ever, the collapse that will follow will unquestionably be the most spectacular. To that end, is Martin Armstrong right about 2015.75, i.e. today, that it will mark the beginning of the end of global collapse? Or Larry Adelson, who claims October 7th will commence the collapse of global governments? Or Gerald Celente, who forecasts a global stock collapse by year-end? Or Bix Weir, who expects the cartel to be run over and run through? Or heck, the Shemitah prophecy, which predicts a global debt jubilee within the next 12 months? I don't have the slightest idea. However, the one thing I am sure of is that inevitably, irrespective of their specific views on financial markets, they will all be proven right in the long term, and more likely the intermediate or perhaps the short term as well. Which is why, more than ever, the time is now to protect yourself while you still can. And if your definition of protection involves the purchase or storage of precious metals, we humbly ask you to give Miles Franklin a call at 800-822-8080 and give us a chance to earn your business. We have been in business for 26 years without a single registered complaint, and if anything, can assure you that our staff of professionals, on average sporting nearly 25 years of industry experience, will make sure all your questions are patiently and efficiently answered and all your needs taken care of. And as always, I can be reached via email at ahoffman@milesfranklin.com. Thanks, and have a great weekend.